Hello and welcome to our Chapter 10 Principles of Accounting 1 Tutoring video, okay? Chapter 10 is dealing with liabilities, okay? So we learned at the beginning of the semester that liabilities are what we owe someone, okay? So you can have current or long-term liabilities, okay? Current liabilities are accounts payable, notes payable, salaries payable, interest payable, and unearned service revenue, okay? Long-term liabilities are things that you owe that you won't pay off in 1 year, which are like mortgage payable, notes payable, or even bonds payable. So you might have noticed that notes payable is in both of those. Whenever you get a loan and a note are the exact same thing. Sometimes you may get a loan for 1 year, okay, and you'll pay it off the next year, or sometimes you might have a 10-year note or something like that, okay? So just a simple journal entry, and I'm assuming you've already read the chapter, so we're just going to kind of go through and talk about all the different types of liabilities, and I'll have a couple of examples along the way. So I won't necessarily do another video talking about problems, but just make sure you have a good grasp of looking in the textbook for other different problems that you can do just for your homework, okay? So, one just little problem that I have an example is if you borrow $90,000 at 7% for 1 year on July 1st, 2014. Okay, so things that we know, okay, we're getting $90,000, so cash is increasing, okay. We know that it's at 7% interest, okay, so we owe 7% interest on the $90,000, okay, and we know it for 1 year, okay. We know that we got the money on July 1st, 2014. Okay, so we automatically know that on July 1st, 2015, we have to pay it off. Okay, so we'll just not calculate, but do our journal entries. Okay, so here's just the example that I had. Okay, so on the July 1st of 2014, you got some cash of $90,000 and you have a notes payable of $90,000. Okay, the second thing you're going to do is calculate your interest. Okay, interest is at the year. Okay, and we know that interest is an expense account, and it's also a payable account. So you're incurring an interest expense. Okay, so that'll be your debit. Okay, and it's your $90,000 multiplied by your 7% interest rate. Okay, and because it's December, okay, and there's a 6-month difference between July and September, okay, you'll do multiplied by 6/12, and that's the same thing we did in the last video, talking about how when you multiply things for depreciation or even expense, okay, if it's for a full year, you're assuming there's an imaginary 12/12, okay, but because this is a partial year, if you got the note in July, you don't have to pay interest on January through June, okay, so that's why you multiply by the 6/12, okay, and then we also know that on July 1st, 2015, that we're going to pay off the loan, okay? So feel free to pause this. This is the last part of the journal entry that we have to do, okay? We're going to talk through it. So you've got your notes payable, which you're eliminating that liability because you're paying your $90,000, okay? And then you've got your interest payable, okay? And you'll notice that was $3,150, okay? That's because we had established a liability on December 31st, but now that's going away because we're also paying that, okay? But again, we haven't paid all of the entire year worth of depreciation. So again, we have another interest expense for $3,150 to account for the other part of the year that we didn't have accounted starting in December, okay? And then, of course, we've got our cash, okay? And you're actually going to pay cash, okay? You've got the amount, the principal that you actually got from the loan, which is $90,000, okay? Multiplied by 0.07, which is your interest because you're paying all the interest, plus the principal, okay, which is $96,300, okay? So that's one thing that you should have grasped, okay, when you read Chapter 10 and did some of your homework, okay? So that's recording a note payable and paying a note payable, and it's also calculating interest. So those are 3 things you need to know, okay? Other things that you need to know how to do are calculate sales tax, okay? And we know that sales revenue and sales tax both come out of the receipts from a cash register, okay? So you'll need to know just your sales tax is just the definitions. You just need to have a basic grasp of how sales tax is accounted for, okay? And then your unearned service revenue, again, you'll need to know what that is. For your unearned service revenue, you'll debit the cash total up front, and then you'll credit all the unearned revenue, okay? And then you'll determine how much amount is earned per entry, okay? So an example for that would be people that buy a bunch of season tickets to a basketball game, okay? They have a lot of unearned service revenue at the very beginning, okay? So let's say they sell $10,000 worth of tickets, and every game they earn $1,000 of that, okay? You would just do a journal entry that every game, okay, after every game you earn $1,000 of what was unearned, which is kind of what we did kind of way back when, I guess, when we were just learning what unearned service revenue is, okay? And then other 2 things you'll need to know how to do, and these are all in the book, are salary and wages payable. So you'll talk about how you've got your total gross pay, and then that's with regular hours or overtime hours, okay? And then you'll base all of your withholdings on your total gross pay, okay? And all that's in the textbook, so just have a basic grasp of that, okay? And then you'll need to know how the employers do payroll taxes. And just in general, the debit for that's payroll tax expense, and then your credit will be your FICA payable, your state unemployment, your federal unemployment, and things like that, okay? So that's kind of the first part of Chapter 10, dealing with kind of long-term liabilities. The next section part of the chapter is dealing with bonds, okay? And the definition of a bond is a debt investment in which an investor loans money to an entity that borrows the funds for a period of time for an interest rate, okay? They're long-term. They're usually due longer than 1 year, so that's why they're a long-term liability. They're a certificate that's traded in a market, so it's kind of like stock, but it's more formal in that it's not ownership in a company, but it's the company taking out loans from people, okay? It carries an interest rate, and they sell at a premium or a discount, okay? A premium is when the bond sells for a greater value than the face value, okay? So that is when the market interest is less than the stated bond interest, okay? It sells at a discount when it sells for less than the face value, okay? So that's when the market interest is greater than the stated bond interest, okay? So if you had issued 500,000 base amount of bonds, okay, at 6% for 30 years on January 1st, 2014, at 103% face value, you know that you're selling it at a premium. Because if it was at 100% face value, you wouldn't have a premium or a discount, okay? So if it's sold for a percentage greater than 100, it's at a premium. If it's less than 100%, it's sold at a discount, okay? So if we were to do a journal entry for that, it would look just like this. Okay, so you've got your cash, okay? And then you've got your premium on bonds payable, and then you've got your bonds payable. Okay? And feel free to pause that and look at that. Okay? So that's a journal entry of how to journalize a bond. Okay? Selling a bond. Okay? You'll need to know how to calculate the cost of borrowing. Okay? The cost of borrowing is equal to interest paid subtract the premium on bonds. Okay? So you'll need to know how to do that. And like I said, all this is in the chapter. So you can take a look at that. Okay, and we just, like I said, we went over the cost of borrowing, so you'll need to know how to do that. And then you'll know the carrying value, and I believe this is a vocabulary word in your book. The carrying value is equal to bonds payable minus discounts on bonds payable, okay? So those, like we just went over, are your long-term liabilities, okay? And like I said, you've already had a good grasp on current liabilities, which are less than 1 year. But like I said, this is just dealing with long-term liabilities. So paying off a house is a long-term liability, okay, if you put it in just an individualist view, okay? So businesses have the same thing. They have things that they have to pay off longer than 1 year, and that's what we were talking about, okay? So just have a grasp on getting a loan, which is also called a note, and calculating interest on that, and then also have a good grasp on what bonds are and how to calculate those and how to journalize those. So I hope that was helpful, and we'll see you next time.